Welcome to today's market report.
European stocks fell on Tuesday as a spike in inflation caused jitters about a possible shift in monetary policy, but nevertheless rose nearly 2% in August on strong quarterly earnings and optimism over an economic recovery. The Pan-European Stoxx 600 index closed 0.4% lower, but marked a seventh straight month of gains in its best monthly winning streak since 2013. Technology was the best performing sector in August, up 6% on several strong earnings, while a rise in global COVID-19 cases also pushed investors into sectors most resilient to the pandemic. Regional stocks had shed early gains on Tuesday after data showed inflation surged to a 10-year high in August, with further rises likely challenging the European Central Bank's benign view on price growth. Governor of Austria's central bank also sent some shivers through the market when the governor called on the ECB to start tapering bond purchases. Concerns about tapering, along with some month-end selling, pulled European stocks away from near record highs. Basic resources stocks were the worst performers in August, down 4.2%. As wild swings in metal prices saw investors pull out of the sector, which has otherwise performed well through the year. But strong earnings and a relatively high rate of vaccination have boosted European recovery hopes, while the US Federal Reserve's remarks last week reaffirmed views it was in no rush to tighten monetary policy. We are still riding the power wave, according to Oanda. On the China side, it's worth noting that it's been priced in for a while. While the data is quite weak, the situation has evolved over the last couple of weeks. Stoxx 600 on longest monthly winning run since 2013. Meanwhile, data showed German unemployment fell more than expected in August. The country's centre-left SPD extended their lead over Chancellor Merkel's Conservatives, according to a latest poll published on Monday, just weeks ahead of a general election. Analysts expect European stocks to hold around current record levels for the rest of 2021, supported by stellar earnings, while worries around US monetary policy tightening, German elections, and a Chinese regulatory crackdown will cap gains. The GBP/USD spiked to 138.07 during the American session, reaching the highest level in 2 weeks, and then pulled back quickly back to the 137.50 zone. Cable remains unable to move away from the 137.50 area. The moves in GBP/USD were driven by the US dollar that is moving sideways on a volatile session. The greenback benefit from higher US yields over the last hours. The 10-year rose back above 130%. Market participants await Friday's NFP. Economic data from the US on Tuesday showed the Conference Board's consumer confidence declined to 113.8 in August from 125.1, below the market consensus of 124. The Chicago PMI fell to 66.8 in August from 73.4, also below expectations. On Wednesday, PMIs and the US ADP employment report are due. The cable pair continues to move sideways around 137.50 level that is working as an equilibrium level. Another daily close here would be the third in a row and the fourth out of the last 5 days. A daily close above 137.85 would be a positive development for the pound, while under 136.90 the bearish pressure should intensify. The bias still points to the downside in GBP/USD. The current bearish perspective in the short term should be negated with a firm rally above 138. Euro-dollar was near 118 by the closing bell, below the 118.45 highs and of the 117.93 lows. The single currency picked up a bid following inflationary pressures reported in the euro area, with the flash CPI estimate for August coming out hotter than expected. This was sinking the dollar index due to the prospects of the convergence between the European Central Bank and the Federal Reserve. ECB's Philip Lane was a key takeaway from the Jackson Hole, basically promising to collaborate the QE program to financial conditions, both in an upwards and in a downwards direction.
This is today's market news. Thanks for listening. We'll see you next time.